In this video, you're going to learn what a cash flow statement is. I'm going to show you what it looks like and how you can use it to measure how well your business is using its cash assets to generate value. I'm Colin Sweetman from First Accounts. Welcome to episode 5 of Financial Understanding. A cash flow statement essentially allows you to see how much liquidity is in your company and how well it is financed. You can also create cash flow forecasts to implement changes in your business. And of course, like the other two statements previously discussed, we're going to go after the cash flow statement's naming conventions, its structure and format, and dive into the details of the line items and elements that make up the cash flow statement itself. So, why do we need a cash flow statement to begin with? In many respects, a cash flow statement looks very similar to a profit and loss statement. The difference arises from the accounting treatment applied to transactions under two different methods of accounting. These two different accounting methods will lead to different financial results. The two accounting methods are called the cash basis of accounting and the accruals basis of accounting. Let's go through the difference between the two. Under the cash basis of accounting, you recognize revenue only when you receive cash from your customer, and you only record expenses when you pay cash to your supplier. Very simple, and a lot of businesses prepare accounts under this method. Under the accruals basis of accounting, it's slightly different. You recognize revenue when the job is done or the goods are delivered, i.e., you've earned the income, regardless of when cash is received from the customer. And yes, this can be before or after the job is complete or the goods delivered. You also record expenses as they are incurred and not when you pay for them. If your business is using the cash basis of accounting, it essentially means that the profit and loss in the cash statement will have the exact same results. So you don't need to prepare a cash flow statement. However, if you or your accountant use any of the international or national frameworks for accounting, such as IFRS or FRS or GAAP, you must use the accruals basis of accounting. Under the Companies Act 2014, companies and directors in Ireland are generally expected and obliged to use these reporting standards when producing financial statements. So what does this mean for companies in Ireland? It means that the accruals basis of accounting must be used for financial reporting, and your company needs to prepare profit and loss statements that show earned revenue and incurred expenses, but they also need to prepare a cash flow statement separately to understand cash flow movements. Okay, but what is a cash flow statement? The official definition is given as a statement showing the movement of cash inflows and outflows over a period of time. But what does it look like? We start with the opening balance of cash at the start of the period, and this can be taken straight from the balance sheet. We end with the closing balance of cash at the end of the period, also taken from the balance sheet. We then need to find and explain the differences between these two balances, which is called the net increase or decrease in cash. Cash flow statements are separated into three sections. The first section is called cash flows from operating activities. These activities are the main revenue generating activities of the business and include the buying and selling of goods and services. The second section is called cash flows from investment activities. This includes more long-term activities of the business, such as the purchase and sale of capital assets and the purchase and sale of fixed assets like buildings, machinery and equipment. The third section is called cash flows from financing activities. This includes any activities that involve financing the business, like the repayment of loans or raising of equity and payment of dividends. With cash flow statements, positive numbers are cash inflows and negative numbers are cash outflows. There are actually two different ways you can prepare a cash flow statement. The first is called the direct method and the second is called the indirect method. The direct method is very easy to read but actually very difficult to prepare. The indirect method, conversely, looks very messy when reading but is actually very easy to prepare. Let's take a look at both of these statements to see the difference. We'll start with the direct method. Let's take a look at the cash flow statement for a fictitious company called Example Limited. They started their year with €5,000 in the bank. By the end of the year, they had €15,000 in the bank. And so we now know the cash movement for the year was €10,000, but we need to know how the cash moved. During the year, the owners issued €1,000 of share capital to a new investor. That is a financing activity and goes into the financing activity section. They also took out a loan of €10,000 from the bank. This is also a financing activity and belongs in the financing activity section too. They then purchased a machine, an investment in the business, worth €2,000. This goes into the investment activity section. They purchased stock for €5,000 and paid the supplier immediately. We made a sale in cash for €7,500, so we can put that in the cash received from customers line in the operating activities section. We made another sale for €2,500, but it looks like it is still owed to us at the year end, and so this won't appear in the cash flow statement. If we did receive the cash though, it would go into the cash received from customers line within the operating activities section. They also paid their sole employee €1,000 in gross wages, which is split into €800 net wages paid to the employee and €200 paid to the revenue commissioners. They also paid €500 interest on the bank loan, and now you can see that this matches the difference between the opening and closing balances. The indirect method is only slightly different, so let's take a look. The financing activities section and the investing activities section are actually the same in both methods, so we can just put them back in. The difference lies in the operating activities section. We start by simply lifting the profit or loss figure from the profit and loss statement and then add non-cash items back to it, like depreciation and amortization, or gains and losses made on the sale of non-current assets. We also need to deduct increases in items like stock and receivables, because the more we have of these, the less cash there is, and add back increases in payables, as the less of this we have, the more cash there is. And there you have it. That's how a cash flow statement works. I appreciate that it may look very difficult to understand, and if so, it's best to look back on the sections again just to get a reiteration of what's going on behind the cash flow statement. Now, on the right hand side we have the consolidated cash flow statement, also sometimes called the statement of cash flows. This shows how much cash is generated and how much cash is being used during a given time period, so similar to the profit and loss above. The main categories found typically in a cash flow statement would include operating activities, investing activities, and financing activities. One of the primary reasons cash inflows and outflows are observed is to compare cash from operations to net income. So I'm looking here, we can see that the profit was 80 million for the year, but down here we have net closing cash of 100 and net generated of 201 million. This comparison helps company management, analysts and investors to gauge how well the company is running its operations. The cash flow statement reflects the actual amount of money that the company receives from its operations. The reason for the difference between cash and profit is because the income statement is prepared under the accrual basis of accounting, so stuff that happened in the profit and loss is just an accrual. It didn't actually happen in terms of someone actually paying money. So depreciation of assets would be something that would be done on an accrual basis, where it matches revenues and expenses for the accounting period, even though revenues may actually not have been collected and expenses may not have been paid. So there is a crucial difference between profit and cash flow. Well, that's it for this episode. We hope it was useful to you on your business journey. If you have any questions, of course, please feel free to comment in the comment section below, and hopefully you'll watch the next episode and it'll be equally as useful to you. See you in the next one.